got a sup from Dr. Woods.
Just on the lag that you talked about in terms of the flow on for interest rates, and noting that it was a split decision of the committee. Really interested in some of the debate that went on around the 0.5 increase, because on page 34 of the report you talk about that some households haven't taken advantage of fixing it the lowest rates because they're anticipating further rate cuts, and was thinking you've signalled 2 more rate cuts. Is the danger that people are going to delay realising the full potential of falling interest rates because they're still waiting out to the end of the year for the lowest rates? And what was the thinking of the bank in the debate that went on at the committee?
I'll pass to Karen in a minute on the sort of effective mortgage rates and the like, but just to speak firstly to the vote and the different views that were around the committee. The first one was, a consensus around the weaker economic activity that had occurred, and therefore the amount of more spare capacity there in the economy, and that central projection that interest rates could go lower over the projection period. So we were aligned around that. Then it was really the argument for a 50 basis point cut was that businesses and consumers were being overly cautious, and they really needed quite a large, substantial kick to sort of get out of that rut and lift that confidence and have that sort of guardrail that monetary policy is here to support the economic recovery. That was the argument for.
But was that bringing forward one of the signalled later cuts?
Yes,
into this round?
It was an issue of timing, effectively.
Yeah.
That's a very, very good point. So those voting for, we were all the same on the path. Those voting for 50, it was about timing. Bring it forward, get it in early. The argument for the 25 was actually we've done a lot already. There's some that we know is going to come through quite soon through people rolling on to the lower rates that as they occur, and also that we actually getting a lot of signalling benefit from the fact that we've put out that projection showing that our willingness to go down to 2.5%. And that is, given that that's what markets weren't pricing that in, we've had an impact on the market. So market rates have moved, the currency's gone lower, all of those things. And so that way monetary conditions become easier. So
you're anticipating that banks will start pricing in these signalled rate cuts before they come at the end of the year?
That's right.
So we saw that ahead of the OCR decision yesterday, and we've seen some movement subsequent, obviously, to that. But Christian's right. We've probably seen, we think, around 50% of the flow through from the cuts that we've already undertaken. So there is a lot of capacity still. There's a lot of stimulation still to flow through into the economy. And yes, people have been sitting on those higher short-term rates.
So 6 months and
6 months. Now there was quite a substantial gap that has been there over the last 12 months. At one point, at least as wide as 100 basis points. That's narrowed quite considerably since then. And so what we have started to see is the movement out from there. So people are looking at 12 and 18-month rates, and that has already started to move through. So, and then we've got 50% probably of home loans to be repriced over the next, or before the end of the year. So we would expect to see that movement come down quite substantially, and within 12 months we would expect to see the average stock rate sitting just below 5%. So quite a substantial movement still to go, and stimulation there. The rate track, I think you've already explained, in terms of there's an indication, there's a signal, it's reflecting that weakness. It will depend on what happens from here in terms of the data, whether we do get to see those green shoots really take off, or whether we continue to see confidence and sogginess remain from here.
Okay, thank you.